One of the biggest mistakes many investors make is over-relying on high-risk, high-reward strategies. The allure is undeniable. Placing all your money into a single speculative stock with the potential to shoot to the moon can feel like a shortcut to wealth. The thrill of a massive payoff from a single bold bet is enticing, but the harsh reality is that this approach is more akin to gambling than it is to sound investing. While you might occasionally get lucky and score a significant win, the odds are far more likely to lead you to significant losses. When your strategy is built on luck instead of sound financial principles, you're essentially playing a game with bad odds. The stock market is naturally volatile, and speculative stocks amplify this risk even further. You could see dramatic price swings that wipe out your gains and more, especially if you aren't prepared to handle these fluctuations. Consider the real-life example of the dot-com bubble in the late 1990s and early 2000s. During this period, technology stocks were hot investments everyone wanted to own. Investors poured money into internet companies with little or no earnings, driven by the hype that these companies would be the future of business. Stocks like Pets.com, Webvan, and many others skyrocketed based on sheer speculation. Investors who jumped in late, hoping to ride the wave, were in for a rude awakening. When the bubble burst in early 2000, many of these stocks lost 80% to 100% of their value almost overnight. For instance, Pets.com, which had gone public at $11 per share, collapsed to mere pennies within a year, leaving investors with devastating losses. Those who over-relied on these high-risk, high-reward strategies found themselves with almost nothing. To illustrate how this strategy can work, let's look at a real-world example: Warren Buffett's investments in Coca-Cola. In 1988, Buffett began buying shares of Coca-Cola, a well-established company with a proven business model, strong brand, and consistent earnings. At the time, many thought he was paying a premium price for the stock, but Buffett wasn't concerned with short-term price movements. Instead, he applied a value-driven long-term investment strategy, gradually accumulating shares over time. By regularly purchasing shares of Coca-Cola, Buffett utilized a form of dollar-cost averaging. He wasn't trying to time the perfect entry or exit point. He was confident in the company's long-term fundamentals. Over the decades, as Coca-Cola continued to grow and generate steady returns, the value of Buffett's investment soared. What started as a $1 billion investment is now worth over $25 billion, not including the substantial dividends Berkshire Hathaway has received over the years. Day trading is often seen as a quick path to riches, with many believing they can outsmart the market by making rapid-fire buying and selling decisions to capitalize on small price movements. The thrill of potentially making money in minutes or hours can be incredibly tempting. It's portrayed in movies, books, and social media as a glamorous and high-stakes game where fortunes can be made overnight.